Hi, my name is Peter Law. In this presentation, I will analyze the Best Buy successful business turnaround strategy. Looking at the table contents, I will begin with the executive summary. Next, I will discuss the overarching challenges that Best Buy encountered while implementing its turnaround strategy. Then I will talk about the perceived obstacle as Best Buy moves forward with its transformation. And finally, we will look at the small wins opportunities that Best Buy has achieved during its successful turnaround strategy. Best Buy is a specialty retailer of consumer electronics, home office products, entertainment software, appliances, and related services. Since 2012, Best Buy has been pursuing a sweeping, difficult turnaround strategy to achieve the profitability of its brand. After most assumed its company has headed to bankruptcy, management executed an impressive turnaround by restructuring the business, cutting costs, cleaning up the balance sheet, and focusing on differentiation through customer service. Multiple channels, selling, financial performance, inventory turnover ratio, and liquidity positions are the company's major strength, even as geographic concentration remains a cause of concern. Focus on marketing strategy, customer experience, and employee empowerment are likely to provide growth opportunities to the company. Today, Best Buy is optimistic about its phenomenal transformation. Still, the company is keenly aware that the turnaround is far from finished. With so many companies focused on short-term earnings, Best Buy's commitment to long-term improvements in the core fundamental of its business gives it a competitive advantage. Looking at this chart, although profits and stock price haven't fully rebounded, Best Buy's management is on the right track in its turnaround strategy since its lowest decline in 2012. Best Buy management admitted that its struggles to grow revenue and profits were not just temporary challenges, but as a permanent shift in the consumer electronic retail business. To recognize the challenges the company faced and how Best Buy needed to adapt. In 2012, Best Buy was plagued with sales decline at 3% and reduced earnings to 90% in its second quarter. In mounting losses and management disarray, the largest consumer electronics retailer in the world reduced its footprint of its U.S. stores, put its retail employees through retraining bootcamp, became a force in e-commerce, and eliminated $1 billion in annual costs. In 2015, comparable store sales rose for the first time in 4 years, up 2.5%, and fourth quarter profit jumped 70% year over year. Since then, Best Buy has implemented a rigorous budget overhaul in its IT division, supply chain, and logistics. Best Buy profit margin has improved from 2.1% to 3.4% in the fiscal year 2018. The company continued to leverage its current footprint across the U.S. to grow its omni-channel business. As a result, Best Buy grew domestic revenue from $36.2 billion in 2016 to $43.3 billion in 2020, even as its domestic store count fell from 1,369 to just 991 over the same time. Looking at these graphs, you would notice that the turnaround strategy was going in the right direction. After-tax operating profit increased 2% year over year. Revenue per dollar invested in this business has improved each of the past 5 years, and after-tax operating profit margins have improved from 2.1% to 3.4% in 5 years, while Best Buy's peers' margins steadily decline. Most businesses say that they put the customer first. However, they often struggle to translate these words into action. Many consumers complain about poor customer service, automated call centers, products not performing as promised, and a lack of information to guide purchase decisions. With its turnaround strategy, Best Buy store staff are cross-trained to fulfill online orders, provide in-store customer service, and virtual customer support. More than just facilitating the physical shopping and product demonstration, stores also serve as service centers for the company's Gig Squad, fulfillment center for online orders, and customer pickup and return location for online orders. No other retailer can match the depth of services offered by Best Buy store and e-commerce operations. The table below illustrates all the services offered at Best Buy. Best Buy operates primarily in the US, and this could limit its revenue growth. Dependence on the US market makes the company vulnerable to economic, social, and political instability in the region that could reduce the demand for its products or prevent customers from coming to its stores. This also places Best Buy at a disadvantage as geographically diversified companies such as Walmart. In addition, Best Buy stores have become more of a problem when consumers shop at Best Buy store, then use the information and advice received to make informed purchase at lower prices with online retailers. The company's business model must change to survive. As Best Buy moves forward with its transformations, the company must be aware of perceived threats it could encounter. The company operates in a highly competitive retail market. Therefore, there are always new challenges in a competitive segment while facing ongoing issues in the labor market impacted by current events. The tight labor market, government mandate increase in minimum wages, and a higher proportion of full-time employees result in an increase in labor costs. In addition, the COVID-19 pandemic impacted many businesses, big and small, from normal operations. Furthermore, Best Buy needs to find ways to work with vendors and network carriers to innovate and drive values in the technology sector of mobile devices. The success of the turnaround strategy is dependent on the foresight of the management team to increase Best Buy's position in growth opportunities. Best Buy will need to continue to diversify its business and services to build momentum for its successful turnaround strategy. Best Buy put the customer in control. In its turnaround strategy, the sales associate's role is to serve as a source of information so that customers feel confident making buying decisions. Best Buy has not only survived the retail apocalypse during the pandemic, but it has emerged with the most developed omni-channel experience in the market as it reaches customers with its physical store, online platform, and in-home service. Furthermore, Best Buy aims to leverage its entry into digital healthcare and wearables, an area of potential growth, especially as a retiring population get increasingly tech-savvy. Expanding into digital healthcare significantly expands the company's growth potential. Strong financial performance enabled the company to provide higher returns to its shareholders and attract further investments. Growth in revenue and profitability also enhanced the company's ability to allocate adequate funds for growth and expansion. There is no doubt that companies must be more than maximizing profits. At Best Buy, employees are given the freedom and ability to share what they do and how they do their work. Every employee is encouraged to reflect on and share what drives them, as well as articulating and constantly feeding the connection between that personal purpose and the company's strategic goal. An analysis at Best Buy's financial ratio shows that its operating margins, net profit margin, and return on investment are trending in the right directions. Its free cash flow per share increases year over year. Best Buy's debt-to-equity ratio is at its lowest in 2021. Overall performance in these categories continue to help Best Buy grow its market share. Looking at the 5-year stock price forecast shows promising results as the trend line is moving in an upward direction. Best Buy's high-touch customer service and expansive store network position it for continued success. Best Buy still presents a quality risk given the company's growing e-commerce market share, efficient omni-channel strategy, and superior profitability to its peers.